Today we're going to be talking about the importance of the Asian range and where London opens. You don't want to miss this. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Again, a lot of great emails, a lot of fantastic feedback. Thank you for the questions. I've received a ton of questions about looking at the Asian range. We're going to talk about that today, and we're going to talk about the importance of that 12 candle window and where London opens in relation to that Asian range. And we're going to also go back and clarify some things about plus or minus 25 to 50 pips. Now, as you can see, and I can tell by the emails, number one, hopefully this information is helping protect you from getting caught in the middle of stuff and getting stopped out in a trade that maybe isn't going anywhere, or if you're in a trade and it's in the stop hunt, not getting out with at least 25 pips or more. The importance of this is understanding ideally when to position yourself in the market when it's preparing to move with the least amount of risk and the maximum reward in terms of a 4-to-1, 5-to-1 profit target. Now, we're going to go through a couple of things again. The importance of simplicity. We talk about using the high and low of the day of Asia, of the previous day's range, and we're going to go through some examples on the charts afterwards in terms of identifying where the real high and low is that you could potentially be trading in heading into the Asian range. The next important part that we talk about is the equity market opens. Now, if you've been following things along, you'll know that when London and New York open, and Asia as we head toward further in the week, often at the beginning of the market opens, there will either be a stop hunt or a move for at least 50 pips. And that's the important part, is understanding that either there's going to be a stop hunt or a trade. The next thing we talked about was the importance of double zeros. Now, I've received a lot of information or questions about the other numbers, the importance of the numbers, but essentially what we look for are where the main levels are that we're possibly trading around or in between, because that's where a lot of institutional orders will take place. We could be in a 100 pip box, we could be in a 50 pip box, but essentially the market will shift largely around these numbers. And then we talked about the importance of the 12 candle rule. Basically, the hour before London and New York, the hour afterwards, and the hour of the open and the hour afterwards. So basically, that's before, that's the open, and that's the hour after, because that first hour is either the trap or the trade. And then we're going to talk about the importance of, specifically today, of 25 to 50 pip movements and where London opens in relation to that Asian range. So essentially the market could, we're going to get a bit more detailed later about 3 levels of rise and fall in terms of not only the intraday cycles but the weekly cycles. If you're an end of day trader, this will apply to end of day, 3 days, 3 weeks, 3 months. It's all the same. When the market has 3 significant levels of movement, depending on the increments of the time frame you're trading, that has relevance. And with Monday to Friday, typically a market will not really go much longer than 3 days in one direction. Payrolls being the exception, where often we'll see a 4th day of rise or fall heading into the Friday payrolls when they're going to reverse it strongly the other way. So if we just take any sort of area, we could say that Asia comes in and trades and goes through a range and then consolidates heading into the London Open. What I look for is where this market, what levels, what 25 pip box is this trading inside of. So yes, we have stops here and we have stops here, but we are inside of a 25 pip box. What's important about this, and again, we'll talk about this in the other videos about peak formations. If we're in a downtrend, lower highs, lower lows, 3 days of drop, 3 days of rise, whatever it is, typically I will be looking, if I'm going to be looking for a short trade, I'll be looking at plus 25, plus 50 as a potential stop hunt area for the market to continue to move down. If the market, when Europe opens, if the market heads back up to hit stops up here, okay, it may push through to this upper level before opening up with London up top. Now in some cases the market may move strongly up 50 pips. In that 2 a.m. window, if the market bursts outside, we want to be looking for this 25 pip increment above the Asian range. So if this is the Asian range, and it could be a 50 pip box, but we're concerned about where it closes, where it trades in at the end of the session. If this is 25 pips above, we'll be looking for a particular type of pattern to show up here. We're going to get a bit more into the types of candle formations we look for, but essentially if you see any sort of tails up top or engulfments where we have a bull candle and then a bear candle that takes this out at this area, we're not just talking about blindly selling that. We want to see a formation where the market has reversed and come back down towards the low of the day. Now if you think about the math in simple terms, if we're in a 25 pip window and traders are just blindly hitting the numbers, that could jam you into a 25 pip box. Once we get out 25 to 50 pips, we're looking at a minimum of 50 pips back to the low of the day, which again, remember, we have stops down here. Now if the market was to burst out and come through that level and heading into the London Open had a tail on the bottom, I would not be looking to short that at that increment. Again, we're going to talk about this more in some future videos. That could see another 25 pips of movement heading north. If the market, and the same thing goes for the downside, if the market was to pull traders down first and open up down low, the stop hunt can occur back up into the range, possibly to the high of the day before rolling over. But again, we are looking for 25 pips above or below the range. Your other technical analysis will give you some input in terms of whether we're in a down move or an up move. Now, let me just wipe this off. If the market, when London opens up inside of the Asian range, there are two scenarios that we can be looking at, and that's level 1 or level 3. If you are in the third day or the third level of drop, so say we've been coming down, we've had 1 day of drop, 2 days of drop, and we're into the third day of drop, and the market comes down, often they will jam traders in with a sell candle. If we were selling, for example, at the London Open inside the range, okay, it could be a bear candle with a pin up top. They will jam you in down low, and that market will basically jam inside of a 25 to 50 pip range. So what that means is that effectively they don't give you a chance to take off much profit, but they also don't stop you out, and they don't give you a chance to go to break even either, and eventually that trade may peter out somewhere over here before it reverses, but you have to sit in all that sideways action. The other scenario is when, sorry about the mess, okay, if we're up in level 3 the previous day, as we saw yesterday in the pound yen, for example, the market may have put in a peak formation the day before, it drops down and goes into a tight range. That market, if it opens up inside, will often break out and continue and not give traders a chance to get back in. Again, level 1, level 3. That's when you'll see London open up inside of the Asian range. Separate from that, in that Europe changeover between 2 a.m. and 3 a.m., if the market goes outside of Asia's high and low, we're looking at 25, we'll just rewrite this, 25 to 50 pips as a possible stop hunt area for the market to either go up high to sell. In some cases, it may drag traders down low first and bring it up 25 pips before it drops, and vice versa. But the importance is, where does London open in relation to the Asian high and low? So hopefully that clarifies things. We're going to go through some examples on the charts, but the safe area is 25 and 50 pips above the Asian range. If you're not sure, wait. If it doesn't make sense to you, wait. If you're not already in a trade that's trending, wait.
Okay, traders, let's go through a few examples now. So we were talking about identifying the 25 pip box that the market is trading in. And so we'll just randomly go through some charts. You can see if we started on last Friday, for example, the market on the pound Aussie had already moved up before we come to the session. But as you see, we're between 50 and 25 as we head into the Europe Open. And importantly, you can see the market came down below that 25 pip box but traded back inside of it. And even though there's a high above that market, actually we'll put our Farber lines on there, and that shows us where the stops are. But again, if we identify the 25 pip box that we're trading in, that's what's important, because then we can project our strike zones at 25 and 50 pips. Okay, now traders who were looking for an entry, possibly a stop hunt low to trade this long, were forced to pursue this higher. Traders, the London Open candle opened up at the high of the day and moved 50 pips. Now that's a great scenario for traders to understand. That is different than the market during the Europe changeover. The Europe changeover, and we'll blow this up a little bit. You can see the Europe changeover in this area. First candle, second candle, third candle goes through the high and then consolidates at the end of the hour. The London candle breaks out, goes up 25, comes back to 50, and then goes up 50 pips again. So that London candle protected traders. Traders who were long on the break of the bear candle were long. But again, our most important scenario with this is, number one, where did London open? It opened up at the high of the box, not outside of the box. But our 25 and 50 pip increments for traders who felt that they missed the trade, again, London trades 50 pips up, it consolidates, New York hits the high one more time at the double zeros and moves back down 75 pips, stopping out the traders who were long in the Europe session. Monday, yesterday, again, the market is in a 50 pip box. Heading into the Europe changeover, we're inside of a 25 pip range down at the bottom, but the market obviously is in a 50 pip box. Okay, so between 75 and 25, around the double zeros, this is our midpoint. Stops are hit up top. Europe breaks out of the high of the day in one push, two push, pulls back, paints a hammer long, but at the end of the hour paints a pin hammer at the end of the hour. The London market breaks back inside the previous day's high, and then we see it move down to the low, the real low of the real box, which we see is 25 50 pips below the Asian range. So again, if you're looking for areas for where the market could reverse, we head into the New York session, and at the low of the day, 50 pips below. So again, we 25 and 50 pips below the Asian range, New York hits the stops and moves back up 50 pips to the redrawn high of the day. We talked about an example of a market going sideways. This is a great example yesterday on the pound yen. So we had an M formation, possibly a peak formation, and if we scrunch this chart up, we can go back and look at level 1, level 2, level 3, big M formation on Friday night. Then the market has consolidated in a 25 pip range underneath of this peak formation, underneath. And as we head into the Europe changeover, the market is trading inside of this 25 pip consolidation. This is an example of where if you can identify a peak formation may be in place and the market has consolidated underneath of that, that London, the London candle, will open inside of the range. An example of where the market will move quickly 50 pips or more before it goes into a sideways consolidation. And again, traders who were heading into New York were looking for a measured move, which we saw. But important to, again, identify, not necessarily, we know there's stops in place. We'll just put our Farber charts on here. We know that there are stops in the market above the high and the low, but we want to identify the 25 pip box that we're trading in, or 50 if it's a 50 pip box, and then project our levels for potential stop hunts. Or profit targets, or points of where reversals or continuations could take place. So the market pushed through the 50 box, gave us an anchor point before the stop hunt hour, which we're going to go into in one of the next few videos. It came up from top to bottom, 36 up to 85. That's a 50 pip movement from high to low before it rolled over at the previous day's low at numbers at 75 for a measured move down. Again, just previously in the week, we had a peak formation at the previous day's high. We saw the market do a 50 pip stop hunt out of the Asian range. If we projected our levels 25 and 50 pips below, we saw the market reverse off this level and go back towards the high of the day, at which point it went 25 pips above into the New York session, and then again hit the high of the day one more time, just below the 50 pip 00 area. So again, identifying where is the 25 pip box that we're trading in. Okay, if you're not, we don't necessarily need to participate in this move, but we want to look at strike zone areas of where the market can move to once it's outside of the Asian range. Market broke out to hit the stops above Wednesday's high, pulled back, went through the 25 pip increment, 50 pips, and again we see the tail, the pins start to go on the top side, and we see that market push down almost 50 pips from top to bottom, well, over 50 pips from top to bottom. Traders would have got 40 to 50 pips somewhere depending on their fill. And again, we head into the New York session. But again, just two simple things. Where is the 25 pip box that you're trading in? Where does London open up in relation to that high and low? If it's inside, you have two scenarios. Level 1 for a continued move off of a peak formation in a trend, or if you're in level 3, you could be getting jammed in down low somewhere for a 25 pip possible reversal or stop hunt. And again, once you have that box defined, you can project your levels for possible areas where the market will reverse heading into the next session, or even reverse if it's a stop hunt. Or if you're trend trading, looking at 25 and 50 pip increments to take your projection level for price entries for measured move back with the trend. Try and work with the numbers, but again, each day identify your 25 pip box. We know where the stops are. They're above the highs and the lows, but we want to know when the market bursts out, where does London open? This is a great example. Market burst out in the London Open, took traders down low before at the end of the hour painting a nice hammer and tail for the move back through the high of the day for 50 pips up. So hopefully you got some value from today's video, traders. Identify your 25 pip Asian range. Okay, so if you're in a 50 pip box, identify your 50 pip box and then go 25 pips above and below. If the market's consolidated inside of a range around a median price, we talked about that last week. Okay. Again, there's two scenarios, level 1 or level 3, where the market will move into a fast move back towards a previous peak formation, or it will jam you in if you're down low or up high on a level 3 trade. Again, just practice this, go back through yourself, look at your numbers. If you see its median price, then we use the high and the low, and then we can project our increments from there as potential turning points or stop hunt areas for the markets to reverse either in the London session, or if you miss that move, or if the move doesn't give us a clean chance to trade that, we come back later for the New York session. And again, just thinking simple in math, 25 to 50 pips. If we're down low or up high, that gives us at least 50 pips from high to low. The market may only go 25, but at least we've got a 50 pip range where the stops are to go to the next point to enter the market. Stay disciplined, traders. Stay focused. Keep the questions coming. Hopefully this provides a bit more clarity on things, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.